Well, thanks everyone for joining us today for our webinar, Business Succession Planning in 2020. My name is Mike Witzke. I am the chair of the Estate Planning and Probate Practice Group at McDonald Hopkins, and I'm based out of our Detroit office. With me today are my partners, Katherine Wensink from Cleveland. Hello, Kate.
Hey, Mike, how are you?
And also Adam Grais from our Chicago office.
Hey, everybody.
We're not going to be able to take any live questions during our discussion. However, we'll be happy to address questions from the audience at the conclusion of our presentation. You can submit your questions by emailing us at events@mcdonaldhopkins.com at any time during the webinar. If you've submitted questions in advance of the webinar today, we'll try to cover those questions during our general discussion. So we've got quite a bit to cover, but let's get started. There's a little bit here. Let's see. Make sure we advance this properly. Adam, can you advance the slides? There we go. So there's a little bit of information here on each of us. Adam is our newest member in our Chicago office. Adam, do you want to talk a little bit about yourself and your practice?
Sure, thanks, Mike. So you're right, I joined McDonald Hopkins back in February. I've been practicing in the income tax area for over 25 years now. I started at a large law firm. I then spent a couple of years in the family office of one of the wealthiest families in Chicago before moving back into private practice at a smaller firm where I was the managing partner. And I've really enjoyed my time since joining McDonald Hopkins a couple months ago. And I want to thank you and Kate and everyone at McDonald Hopkins for a smooth transition. Since joining the firm, I've really been impressed by the creativity, teamwork, and client-oriented focus of everybody at the firm. And, you know, it was nice of you to call me on my very first day. You were my first call, Mike, to start planning for this. Unfortunately, circumstances intervened and we weren't able to do this in person, but I'm really excited to get this webinar going and to introduce all of my clients and contacts to McDonald Hopkins. And look forward to getting together in person with everybody when it's safe to do so, which I guess brings us to the topic of our conversation today, which is succession planning in 2020, planning for a world of COVID-19 and beyond. So Mike, should we take it from there?
Yes. So I want to make sure here I can advance. So obviously we're talking about business succession planning. And, you know, when Adam joined the firm and we started planning this, obviously we were not planning to do this with the overlay of COVID-19 kind of affecting all of our businesses. In so many ways, as well as the overall economy, valuations, interest rates, all those things now have been affected tremendously since we started this planning. And so what we wanted to kind of start out with is, why is this even more important than ever to be thinking about how to plan to transfer your business and do it in a way that's going to ensure the success of the business long term, as well as to make sure all of the goals you have for that business succession are achieved. So certainly the biggest issue that we've got is that there are estate and income tax changes coming. So Kate, do you want to talk a little bit about, you know, maybe the estate tax issues that we have coming toward us?
Sure. Right now we have an $11.58 million exemption that can be used per person. So married couples can use almost $24 million together. That is set to sunset, if not earlier, at the end of 2025. And so what we're looking at right now is an environment where if we can make those larger gifts, we want to. And if you had asked me in January if this was going to be changing, I would say, well, probably at the end of 2025, unless Congress agrees, which we don't think is likely, it'll be dropping back down to that roughly $6 million. The difference, though, is we're going to have to, as a country, pay for all of these changes and all of these stimulus packages. And so I would not be surprised, and I think none of us would, if that number goes from 11.58 million to something significantly lower in less time than 2025.
And certainly, I think the Democrats have proposed an exemption of, anywhere from 3 to 3.5 million per person. Even that could change. Some of the Democratic candidates for the nomination obviously had much lower thresholds that were available. And with over 2 trillion already have being allocated or paid out under the CARES Act, certainly there is going to be a bill that comes due for this, both in the estate tax area and then also on the income tax area. And so, Adam, I don't know if you have any thoughts on that you want to kind of share about what potentially could be coming in that area as well.
Sure. Yeah. Let's talk about the income tax side a little bit. So, just as with the estate tax, there's some expiring provisions related to the 2017 Tax Cuts and Jobs Act. So, tax rates went down in the Tax Cuts and Jobs Act, and they're scheduled to go back up again at the end of 2025. So, the highest tax bracket's going to go back up to 39.6, assuming nothing happens. There are also some special deductions, like the 20% qualified business income deduction that applies for pass-through entities. That goes away at the same time. And I think COVID now has sort of put a different, spin on what might even happen with the corporate tax rates. The tax rates for corporations were cut significantly down to 21% in the Tax Cuts and Jobs Act, but there's already been discussions, and I've heard some rumblings from business leaders talking about, hey, we're probably going to have to increase the corporate tax rate too in order to pay for all of this. So that may be coming as well. I certainly wouldn't expect anything until next year, but there's some rumblings about that. I mean, that's certainly something nobody was talking about a couple months ago. The other thing on the income tax side that's going on in Illinois is we have a referendum on our ballot coming up in November to switch from a flat tax to a graduated income tax. And all of the spending that's been going on certainly is going to require a lot more funding for the hole that Illinois was already in. And so it sort of puts a different spin on this discussion around the graduated income tax as well. And I think you got to think, even if that doesn't go through, Illinois is going to need a lot more money in one way or another. Tax rates in Illinois itself are probably going up.
And you mentioned Illinois, Kate. You talked about the federal estate tax exemption being over 11 million now, probably going at least to 6 million, if not lower. But also Illinois has its own estate tax, and so certainly that's another issue that has to be taken into consideration with our clients and referral sources who are watching or there in Illinois, and how that can affect the transfer of the business as well.
Well, and really now is the time. We thought we had a few more years that we could potentially sort of hold off a little bit for clients that weren't quite ready, but that's really been accelerated.
And I think, when you layer these tax changes that are surely coming our way with lower valuations that we have today due to COVID, as well as historically low interest rates that can be utilized in a lot of the techniques that we're going to talk about, not only today, but in a subsequent webinar that we're going to present, really makes this the time for business owners to be thinking about that exit and how it's going to occur. And so, when we begin this analysis of what do we do, certainly we're planning now in a pandemic. We're also planning for beyond once we kind of come out of this. There is not only the long-term plan that has to be put in place, but there are a lot of things that have to be considered today, because what happens if you become incapacitated as a business owner or you pass away before we get to that 5-year target to transfer? There are certain things that need to be in place to make sure that if you exit unexpectedly, the whole plan won't be thrown out the window. So I think we start out with just an evaluation of the business owner's basic estate plan. Is your will, trust, financial powers of attorney, medical powers of attorney, certainly those have become more important. Are those up to date? When were they last reviewed? Do you have people in your fiduciary roles who understand your business? And if you have a trust, is your business owned by your trust? I think all of those are questions that at a very basic level, we need to be asking the business owner to make sure that if they get sick or pass away prior to that transition date, the plan will be in place to deal with that.
Yeah, I mean, certainly, Mike, COVID sort of brings to mind the need to make sure that your planning's in place. I've certainly had people reach out to me, just sort of finally getting their estate plans done, finally getting to do those things that they've, had on their list for a long time, and this sort of puts a little bit more of an impetus to do that. But also, starting with the estate plan, going into any business succession plan, the elements of a solid business succession plan for retirement and for transfer of the business includes a lot of the same tools that can help a business in a crisis like a pandemic. So you were talking about having the ownership of shares or ownership interest in the company in a trust. If the founder, is incapacitated, then you've got a trustee who can step in and sort of maybe make some of those decisions that need to be made. Now would be a great time to make sure all of your business records are in order. In the same way, that would be important if somebody's coming in to look at your business to buy. If somebody's going to have to step in quickly who's not maybe as familiar with the business, having all those things in order is something that's really important as well. And things like a buy-sell agreement should be in place, because you want to be sure, again, if there needs to be a transition, we've taken care of that orderly transition and made sure that we're ready should something happen. But also, we're planning for those later stages of business succession. The buy-sell agreement can be an important element of that buy-sell if you're looking to sell to other owners or sell to other family members.
And I think if we know who's going to receive the business, who that transferee will be, it's also important to make sure they're going to be ready when that transition occurs. And Kate, do you want to talk maybe a little bit about helping, whether it's a family member or key employees? Are there things that we should be thinking about now to help them prepare for when that transition occurs?
So, yes. And one of the finest things, I was at a business succession planning breakfast many years ago, and Carl Grais was one of our speakers, and he said something, and it was a third-party sort of a thing, and he said something to the effect of, on the day he took the reins at McDonald Hopkins, he already was thinking about his succession plan. And I always kept that in the back of my mind. So now when I meet with clients, whether we're transitioning to the next generation, whether we're going from the very first generation on or the fourth or fifth, as somebody steps in, the question is, who's next? And let's start exploring that now so that that transferee is prepared. There's no sense in telling somebody you're going to be in charge of the firm and then not giving them the business to run. How many catches does a quarterback throw before they're really good at it? It's not one. And so that's getting that. That's why.
Sorry, being in Chicago and you being in Cleveland, we have a lot of experience dealing with that.
There's nothing.
And we don't talk about football in Detroit either, so.
So based on our stellar football teams, but the key is that it's practice. And so getting those transferees in place early makes sense, and giving them a little bit of responsibility and making sure that they can do that, and then pushing forward with a little bit more. That's where you start to see the success.
And
I think, just to sort of pick up on that, Kate, that's something I see even working with startup companies, really planning for the exit at the time you're putting the company together is something I talk to clients about all the time. The best time to be talking about what the exit is going to look like is when everybody's friendly and everybody's getting along, and then you have an understanding that everybody's on the same page and everybody has the same expectations. And having those ongoing conversations as you move along, getting the timing right involves starting early, but it also involves having the flexibility as you move along to, take into account things as circumstances change. Part of, what we're dealing with right now with the pandemic is everybody has to deal with changing circumstances. So the earlier you start planning and the more of a process you put in place to continue to reevaluate it, the better chance you're going to have a successful transition in your business.
Right. Yeah, and that's what we always want to avoid is the fire sale, where if something happens and now we have to sell, we're forced to sell. That's going to dramatically increase the chance that the transition is not going to be successful. So, what is the timing? What's the right timing for transferring or exiting your business? Is it a year, 2 years? Is it today? When do we start?
I think when you sign the incorporation papers. But
Yeah,
to that,
exactly.
the more lead time, the better. And so for charitably minded clients, there are many clients out there that transition down that business, and they then want to make very large charitable gifts. Well, there's a significant tax savings if that gift is made prior to the business being sold with company stock. And so the more lead time we have, we can't on the morning of the closing transfer stock to a charity and then have the charity sell on the day of the closing. It doesn't work that way. But working with families and doing this sometime before, that allows for serious tax savings, more money to charity, and others being helped.
And just to pick up on that a little bit more, even if you're not talking about charitable planning, the real value in doing planning early is the time value of money. Really what we're trying to do with this planning is get the appreciation in your business out of your estate. It's easy to gift when values are low, and then we're not just taking out the value of the asset at the time of the gift, we're also taking that future appreciation out. And then the other thing to keep in mind when you're talking about succession planning and timing is, a business owner may have in their head the time they're ready to retire, but just because the owner is ready to retire doesn't mean the market is ready to buy that business. The business cycle isn't necessarily going to line up with the life cycle. And even if those things seem to be in alignment, we certainly saw things come up earlier this year with deals that were right on track to get done. Somebody was ready to sell their business, and then, all of this came along, and now things have changed. So getting the timing right involves, again, planning and flexibility, and having that early planning so that you're ready when the market is ready is really important.
And then, you talked about the value of time if it's going to be a family transfer, a transfer of the business to family members, allowing for time to utilize trust, to take advantage of that, getting that future appreciation out now, even though maybe control could be retained for a number of years. It's also important, I think, though, too, for if we're selling to a third party, kind of cleaning things up. Often business owners run a lot of things through the business that maybe shouldn't be run through the business, and so having time to kind of clean those things up so that when a third party comes in and starts doing that analysis of cash flow and how the business is set up, it's going to look a lot more desirable to that third party.
Mm-hmm. So. Yeah, and similarly, you've got issues. Frequently, business owners, their largest asset is their business. But sometimes, a business owner may have an opportunity to take some liquidity out of the business and redeploy it in a different way, either in a stock portfolio or even as part of a transition through an ESOP, and then also through the ESOP transaction, redeploy some of that capital into a securities portfolio. And having sort of that combination of liquid and illiquid assets provides a lot more flexibility when thinking about how to do estate and planning and sort of taking care of the family. So sort of balancing the needs of the business and the needs of the family, having sort of that more liquid portfolio can really be a big help.
So, when we talk about what's right for your business, I mean, really, I think this comes down to there's no cookie cutter formula for everybody. And every business is different in terms of how it's set up and what the possible, potential transfer scenarios could be. Why don't we talk a little bit about helping a business owner figure out what is right?
Well, I mean, you're certainly right, Mike. I mean, there's no one answer or no particular time that's appropriate for everyone. I think it's a continuing dialogue. When you've got every business is different, and sort of the needs of the business have to be taken into account, as well as the needs of the family. When you've got a family business, and I certainly saw it being in a family office, there's a totally different dynamic than a business that maybe has a couple of different partners who aren't related. There's this whole different family overlay. So, the different ownership may affect what's going to be right for your business. And you need to be thinking constantly about both, what your family needs and what the business needs, and being sure you can balance those things, again, as circumstances change, either in the business environment or in your family situation. Or, things like we were talking about before, tax law changes.
And often, in a business, there could be multiple owners, not just one family, perhaps, or two owners that are very different in age. And so what might be right for one may not be exactly right for the other. And so all of these differences need to be evaluated. And the team, which we're going to talk about in a slide coming up, is going to be important to make sure we've got everybody looking at what might make sense for the business and what's going to maximize the overall goals. And that's going to come down to, what ultimately does the business owner want to achieve? Do they already have financial security, and there are other primary goals? Or is this business their retirement? And does that really have to be funded, that retirement, through the transfer of the business? So there's lots going on with everybody. And the key is to make sure that we focus on your business and what makes sense and what doesn't make sense, so that the right plan can be put in place.
Oop.
Went too far.
One too far. There we go. Who should get the business?
So that kind of goes to that next question, is to who should get the business. Kate, you want to talk a bit about what my options might be as a business owner if I'm thinking about exiting?
Absolutely. So there's really sort of three types of new owners. That can be somebody down within the family, and that family member may be a child, it may be a grandchild, it could be a sibling, a cousin. And that's what's very interesting about family business and watching those businesses, is when we look from generation to generation, it's not always a straight line. And so it's really neat in working with families where we may see one, the founding layer, and it may be one or two people in the next layer that maybe are cousins and not siblings. And then 3 or 4 people in the third generation that are not the leader's children, but rather are the next group, or one child over. And so it's looking at that. The other piece is looking at within the family, the right person to step in. And what we sometimes will see is that maybe it's not the children at all. And so we have to then factor in things like the generation skipping transfer tax. And is it right to have the grandchildren step in? Okay, that may be, but how do we get the asset to them in the most tax efficient manner? And that sometimes is difficult to kind of meander through, but we do it so that the right family members are leading. And then from family members, and Adam, this goes to your family office, you know, this is actually really one of the nice things about the family office and when you can lay in a private trust company, because you really do have different members at different layers working together. And when you do that, you know, you start to see them excel, and you see the business grow in different really positive ways, and you can see the business start to diversify, where you then also see that generation that's selling continue to have the money to live and to excel. So that's one option. One is to get it transferred to the employees, and in transferring to the employees, the easy answer is an ESOP, right? And I think that the employee stock ownership is a great tool so that you get liquidity to your business owner, but that the employees are now owners as well and now have a say in that company. And now they really are tied to that company. And that really is a nice way to keep it within the company. And then finally, it's a third-party sale. And so all of those need to be explored. And whether and it doesn't have to be one, it can be a group of those options. I mean, we've all seen all of those sort of pieces, parts work together and lay on top of one another for the family.
And Kate, I just want to pick up on one thing you talked about before about sort of who's the logical person to take over and what are sort of the skill sets you need. And you mentioned sort of this idea that, you know, just because somebody's related doesn't mean they might be the best person to take over the business. And so, you know, either the business can be used as a tool for helping educate people in the family to help them become more valuable to the business. And at the same time, when you're looking at sort of who are the executives in the company and having them help with that process, you can have, you know, an executive team that receives equity over time. If you're looking to sort of preserve ownership in the family, but also bring in the employees, you're going to need to sort of create some incentives for them to, you know, to do that work. And so there are a lot of different types of, you know, types of either equity or phantom equity. There are different types of ways of incentivizing the non-family members in a way to make sure that their interests align with the interests of the business and the family. And it all gets to, you know, it all comes back to flexibility, like we were talking about before, and mixing and matching these things, and setting yourself up again so that everybody has the same expectations moving forward, and they're trying to get the business to the point, if, you know, as you suggested, maybe a third-party exit is something that, you know, you may have family members who want to cash out, you may have employees who have a share of the business but are interested in sort of staying on, and the value in the business is going to be the value in those employees. If the value is just in a founder who's going to retire, that's a much different type of transaction than if you've got an established business with, you know, an infrastructure in place that's something that can be sold, which is, you know, again, part of sort of building that business and looking at what the value is. And then when you get to a third-party sale, if that's the route that ends up being taken, it's important to think about what the right type of buyer is. In certain industries, it's going to be a strategic buyer who, you know, that type of buyer might be a better one for employees. And if you're looking at the long-term sort of benefit to employees, is somebody who really knows the business. On the other side, you know, there might be a financial buyer where you might have, you know, might be an opportunity to cash out a little bit more. But those financial buyers also might be able to partner and bring liquidity that the next generation of employees or the next generation of management was looking for in order to take the business to the next level, which might have been something that maybe the founder wasn't ready to do because their interests were different. You know, and again, there's that challenge of finding the right time in the market to sell to a third party. You know, frequently these sales to a third party are the most challenging. When you're selling to a family member, you're selling to an executive in the company, you know those people. These are people you've gotten to know over time. And these third party sales frequently is somebody, you know, you're doing a dance, you're getting to know each other for the first time, you're dating, if you will. And it's harder to know, and those types of transactions can be a lot more challenging. certainly, I think we've all got stories about family businesses that have been bought by a third party. Things don't work out quite so well, and then the family ends up buying them back. And maybe it's because the founder got found, yes, you actually can play so many rounds of golf, you never want to see a golf ball again. And they want to get back into the business again or something like that. So, that sale to a third party is a great option. And you really, in terms of what's right for your business, again, it depends. What is the family interested in doing? What's the best thing for the family? What's the best for the people who are the other stakeholders in the business, those employees and that executive team that are going to help you maximize value?
And it goes to, I mean, sometimes the business owner really thinks it should stay in the family, but the subsequent generations, the other family members are either not interested in taking over the business or maybe aren't capable of taking over the business. And that's sometimes a hard realization, and as you start to decide what's the right path to take, those are often hard conversations that have to be had with everyone.
For sure. I mean, and then you start getting into, we were talking about setting expectations. I think that gets to what's fair. And there's fairness to the family members. There's fairness to those other stakeholders. I get this question all the time when working with clients on estate planning. I mean, one of the first matters I worked on when I came from the family office environment back to private practice was a family business where the approach that the father who founded the business took was, I'm going to be fair by giving everybody a share of the company. Well, there were 3 siblings and they were all in the business. So they each got 1/3 of the business. And the reason I was working on this, I came in after all the planning had been done and the father had died, was, well, guess what? The 2 brothers decided they wanted to run the business one way, and the sister who I represented decided she thought the business should run the other way. Well, 2 beats 1. So, was that fair? Was that necessarily the best thing for the business? I don't know. But that's just even doesn't necessarily mean fair in every situation. And I know we see that a lot of times when we've got family members inside the business and outside the business as well.
And I've had a case where there was 1 child involved in the business, 2 children who were not. Mom and dad thought it would be fair to just buy life insurance to equalize the estate. The child active in the business got the business. The 2 other children just got life insurance proceeds to equalize things. And when this was announced at a family meeting, the child who was in the business said, wait a minute, I get a job and they get cash? How do I switch this? So, what is fair, it takes on a whole lot of different questions. And I think it comes down to, if you've got children in the business, one of the things that one of my partners when I was a young associate told me was that I remember him telling a business owner that if you want your kids to work in the business, you should always require them to work somewhere else first. So they realize that, mom and dad maybe are not the terrible taskmasters that they thought they were, but there are responsibilities in being an employee and doing things that have to get done, but kind of coming up with, what is fair? If you've got children with different, qualities, abilities, how do we decide how that business transfers? And as Kate talked about earlier, maybe it's not children, maybe it's cousins or, your other siblings of the owners that are going to take on this business in the future. There's a lot of different ways this could go, and deciding what's going to be a fair distribution, it often is not equal. And so that's something that has to be considered.
Well, and Mike, you bring up a good point when talking about that family meeting and setting expectations again so that everybody knows going in what's going on. I mean, I certainly had an experience when I was working in a family office. Part of what created a lot of tension within the family was this element of not knowing. You had people in the family business and people outside of the family business, and some of it was just people wanting to know what's going on, setting expectations, and then everybody can sort of know going forward. This is another conversation I have a lot when we're talking about estate planning. It's not a set it and forget it kind of thing and stick it in a drawer. There's the question of, circumstances changing, but it's also important, as you were saying, Mike, with the family meeting, to talk about what the plan is, so that family members aren't discovering, when they're grieving at the last minute, after a family member has died, oh my gosh, I get the business and my siblings get the life insurance policies, or something like that. Communication is a very important part of a business succession plan and in establishing and understanding what's fair.
Well, and just as we look at our estate plan, we can draw those comparisons with estate planning and business planning, that we have a foundation of our estate plan. That cornerstone, that revocable trust, is our cornerstone. And we don't set it and forget it. We look at it if you're one of our clients, you get a little love note from me every 5 years that says, hey, what's going on? But it's also our building block. So we start with that rev trust, and then we start with irrevocable trusts. Maybe we find that the best way to get the business to the next generation is through an intentionally defective grantor trust, where we look, in today's rates, we look at a midterm AFR of like negative, but we look at those midterm AFRs, we set up a separate trust. Our revocable trust works the same way as it did before. The family splits things up the same way as before, but now there's a layer on top. And it's just like we look at our business documents. We have our code of regs, we have our operating agreements, and yes, we can build in some really fancy, nerdy waterfall provisions in those operating agreements, and those are maybe my favorite parts of them. But but then we have those buy-sell agreements, and so the cornerstone is the operating agreement. The buy-sell lays on top of it, and those are both key parts of both business and estate succession. So with communication, with viewing these documents, we set up some really nice tools to help families transition from one generation to the next.
Well, and then another part of that in integrating with estate planning is the importance of holding ownership interests in trust. We talked about trusts being a tool for making sure that somebody can pick up if the grantor of the trust becomes disabled. But the other thing is sort of protecting the business from the family as well, and a trust can be a tool for doing that. If you've got a trust, Kate, you were talking before about a family office. If you've got a family office, a trusted advisor, someone else who can be that trustee, sometimes a corporate trustee if you have a really good relationship, that can be that trustee of the trust and sort of make sure they're looking out for everyone's interests, the family's interests and the interests of the business. And those trusts can also sort of protect the business from family members. One of the things we talk about frequently is this idea of, what happens if a family member gets divorced? Well, that ex-spouse is certainly going to have an idea about what fairness means, and it may be very different from what the family thinks fairness means. And you want to sort of protect the business from having to have that dispute sort of settled and having it get too deeply into the business itself. If those shares were held directly, it's going to be a much bigger issue than if that's been addressed in a trust and is protected from those sorts of situations. We have the same issue with creditors. Yep, go ahead, Kate.
And we want the prenup too. So we start with our prenup, we keep the trust, and the future ex-Mrs. Me is taken care of.
And one other aspect of fairness, I think, Adam, you kind of brought this up earlier, is control. Because if we talk about the business being in the revocable living trust, if the business owner becomes incapacitated, if they were to pass away, often the spouse becomes the trustee. And that spouse, that surviving spouse, may not have any knowledge of the business or interest in the business. There may be key employees now that are concerned about that spouse having that control, or maybe it's one of the children who really has been active in the business and now has to answer to the non-involved, surviving parent who now controls the voting of the business and that sort of thing. So that's something that really has to be considered, and it really boils down to not only the buy-sell agreement, but also the trust document, the powers of attorney to be, if that business owner becomes incapacitated or passes away, who's going to have control over the business? while things are being divvied up and decided, or while maybe that the business owner is just being maintained during a period of incapacity. And that's something that there's often a disconnect. We find that somebody gets sick or passes away, and the people that are in control now of the stock are not active in the business, don't understand the business in many cases, and that often leads to a lot of confusion. It could lead to key employees exiting the business and often taking a piece of the business with them, perhaps. So it's really, again, something that when we talk about fairness in the planning, we have to think about where does that control land on incapacity or on death or on transfer. You know, given that example you gave, Adam, where it goes a third, a third, a third. If the value is supposed to be divided that way, could the stock maybe be split into voting and non-voting so that perhaps the value can be equal, but the control is not?
Well, and really to sort of pick up on that, Mike, a little bit, you're talking about an integrated plan, and this sort of picks up on what Kate was talking about before. You've got to deal with ownership agreements at the end company level. You may have a buy-sell at the ownership level, and you might even go up another tier where you're talking about the estate plan itself. And it's really important to have this sort of integrated plan that goes through all of the different levels. So you're looking at, you know, talking to people and advisors about estate planning. You're talking to, you know, working with corporate attorneys and accountants and looking at buy-sells and working on those organic entity agreements. Then you're also, you know, I mean, you want somebody who can help you who's got a lot of experience with executive comp. If we're talking about how are we going to take care of our executive team to make sure that their interests are aligned with the interests of the family and of the business, that having an experienced team that's used to dealing with these types of executive comp issues is important. And something, you know, I don't know if we'll go too deep into, but is also the retirement plans. I mean, there's a lot that can be done in terms of business succession in building up a strong retirement plan for the owner at the company. And then also just, again, for those executives, even if you're talking about sort of phantom plans or deferred compensation plans, having all of those pieces put together can be an important part of the business succession plan, which is why it's important to have the right team in place.
Well, that was a great transition, Adam. And again, you know, that team, you know, often what we find sometimes is when a client, a business owner gets ready to start planning for their exit, they look around at who their advisors are, their CPA, their financial advisor, their insurance professional, their attorney or attorney team. Often the business has outgrown those original advisors. And if we talk about, Adam, like you said, kind of beginning with the end in mind, we've got to have the right team. There are a lot of moving parts going on in an exit, and you've got to have advisors who understand those parts and can give you the right advice. So if we look at where do we start, you really have to start with having the right team in place, I think, as we begin this process.
And also, just because a firm has outgrown the initial capabilities of, say, the CPA or the original business counsel or the original financial advisor, it doesn't mean that that relationship has to stop. And, you know, we've worked a number of times with a company that we maybe be coming in on the business side or the estate planning side, and maybe they had that solo practitioner estate planner and they've outgrown them, and that's okay. They're a trusted advisor. So we work with that trusted advisor and we don't displace them. If that trusted advisor is still there, we work with them. Now, there are other relationships that don't sort of stand the test of time, but think about how many clients have somebody on their board that maybe was originally a different role, but they've become such a part of the family and such a part of the business that they have the institutional knowledge. And so that's that team. Now, we're part of that team too. And we start with them with that incorporation paper. But remembering that trusted advisor doesn't have to be displaced.
Well, and that's sort of, that collaboration is really important. I mean, whenever I engage with a new client for the first time, one of my first questions is, okay, who are the other attorneys? who's your accountant? Because as a tax attorney, I'm very concerned about making sure I'm on the same page with the accountant. And who are your financial advisors? I mean, that's a team you need to put together if you're going to develop a successful business succession plan, because we all sort of see different elements. And not that a client would ever not tell all of their advisors the same thing or have the same information, but it happens sometimes, you know. So having that communication with all of the advisors and having, you know, all of the right people at the table is very important. And we touched on this a little bit before, Kate, when you were talking about family offices. A lot of times that's what you'll see in the family office, is that's that round table of advisors. I remember when I was in the family office, we'd get together, you know, once a quarter to just sort of look at everything, because you never knew what somebody was going to bring to the table that somebody else hadn't seen. And those conversations were always very important for spotting issues and making sure that we had everything covered and had everything addressed to meet the needs of the family and the needs of the businesses. And that's also those longtime advisors, even if they shifted to a different role, you know, they have that history, as Kate was talking about. You know, why does this oddball thing look the way it does? Well, there's probably a history there, and it's important to have those connections to understand why things are the way they are as we're planning to move pieces around and set things up for a successful business succession.
And having a team member that is kind of secretive, is siloing information. I've seen situations where business succession planning has failed because that team is not working collaboratively, and things are not being shared, and plans are being implemented that the other advisors are not aware of. So it is just so important to have that collaboration, have everybody around the table, as you said, coming in with their own you know, view of the situation, both the history and the techniques that they have available to them to help make the plan a success.
For sure.
What about having kind of an outside business advisor as part of the team, someone who's not in the business but understands the business and could potentially help? Have you seen, either of you seen examples of where that can be really helpful in overall getting this succession plan to be successful?
Well, certainly I've seen clients, and I'd say probably some of the most forward-looking people are always looking to get the best information possible from other resources. So a lot of times a business will put together, you know, an advisory panel, or, you know, depending on the corporate structure, those people can be on the board of directors where they know the business, but they're bringing a different perspective. Sometimes also in smaller businesses, you might have, you know, somebody who knows the business well, who might be either a trustee of a trust for that owns shares of the company, or sometimes the trust, you know, the trustee may be handling distributions, but you'll have somebody else who has a sort of investment capacity or is an investment advisor and is helping make investment decisions for the trust. So you certainly see that, and having that outside perspective there can be helpful. Both, I mean, if you're talking about an outside trustee for distributions, that trustee, when you're talking with family members, doesn't have the same sort of, you know, family relationship, and that can be beneficial sometimes because they can be a little bit less emotional about the decisions that are being made, and also maybe sort of provide plausible deniability for a grantor who set up a trust but doesn't really want to have to be the person to say no to their kids. The trustee can have that role, and you know, it just creates a different dynamic.
Okay, well, I think now we've got just a little less than 10 minutes left. Adam, are you getting the emails of the questions?
Yeah, no questions so far. So we've got a little time to sort of continue to talk ourselves. If we've got some other things we want to go over, we can sort of go into a little bit more depth on some of these things. I know, Kate, you had been talking about family offices a little bit before. Maybe we can talk a little bit about sort of the role a family office could play in business succession planning.
Well, it goes exactly to what you were talking about earlier about the collaboration. And one of the neat things that we've seen is as we've worked with different families and different family offices, is how an individual may come in and lead one area, and then they may move to another, and having the outside advisors of the family office, meaning the people that are not necessarily family members, they are able to issue spot in some ways and help people find the right fit, so that when the next business comes on, they know who should be leading when they're diversifying portfolios and buying new businesses and new, as it were. Do we want to chat just briefly we've alluded to the low interest rates. If we're ready for clients to transition, or clients are ready to, we do want to look at the idea of doing it through something like an irrevocable trust, whether it's a beneficiary trust or an IDGET, where we freeze the value. We're then able to move all of the growth out, and to be able to do it at these interest rates, it's unbelievable. And we've seen it too with grantor retained annuity trusts, that in an asset that has a lower value right now, and as the value grows, we get that appreciation out. And those are just two little things that we can do in this environment to help transition and move our succession along.
And I think it just can't be emphasized enough as to how there is an opportunity now, especially if we have a business owner who wants to transfer the business to family members, to minimize the overall estate tax cost of that, the gift tax cost of that, utilizing the ability, taking right now an opportunity to compress value so that we have a low valuation. We have low interest rates. The trust that Kate has talked about in terms of these sophisticated irrevocable trusts that can be created, really, it's an opportunity that just shouldn't be missed. If you're thinking about transferring it, and the ability to build in asset protection so that if your children are sued or to get divorced, the business can be protected. The ability to retain some control over the business as you transfer that business down to other family members. All of this right now, it's an ideal time, and that's again, in terms of this crisis that the country's in with COVID right now, this is an opportunity that presents itself that I think a lot of smart clients are taking advantage of, to be able to shift their wealth, to shift their business at a very low tax cost, and then, like I say, to build in additional protections for that business as it's transitioned down to the next generation or to other family members.
Yeah, I mean, certainly a lot of us have maybe more time that we're spending in close quarters with our family, and it presents an opportunity also just to talk about these sorts of issues. As we've talked about a couple of times, communication is really important. And as you're putting these plans together, talking about what those family values are, what are the things you're trying to imbue with other family members and through your business is a unique opportunity that way also, just to sort of think about what you want maybe with a little bit more time. And with, unfortunately with this pandemic facing us, it sort of puts a little spin on it, maybe crystallizes some things. And, now, I mean, I think we've had some clients who are finally saying, okay, I've been thinking about doing something. I have some idea of what I want. Okay, now I'm really concerned, and I really want to make sure I've got something in place so that things are taken care of. And so, now is the time to act for those reasons. We've got this unique opportunity economically, as you just alluded to, Mike. And as we talked about before, all of us earlier, having the benefit of having time and flexibility to adjust the succession plan is really the thing that is going to make the succession plan a success. And part of what we've got the opportunity to do right now is get the family and the business people together to, come up with what their definition of success is, and come up with this plan with having the right team, and talking with everybody to sort of get going and get that done.
I did just get a call from a client that is now in the second generation of the business, And they are using this time to kind of put together almost like a family business manual, which is a listing of rules as to what does it take to be able to work here if you're a family member. What experience do you need? What education do you need? And then it layers on up from that. What would it take for you to get a role in management of the business? And then ultimately, they're talking about, okay, what criteria should we put in here for someone, a family member, to ultimately be an owner in the business? What does it take to reach that level where you would be eligible, either through inheritance or through, some type of purchase of the business interest? So this is a unique time. Many businesses are shut down. Many businesses are as we reopen the economy, are going to be operating on a much lower capacity. And so, again, that lends toward maybe there is some extra time now to think about how do we transition this business effectively and get the team involved, get our other advisors brought in, sit around, let's get talking about what are our options, what's the best plan for our business, what's fair given our family or given the employees that are involved in this, and what steps can I take now to ensure that when I'm ready to transition, the transition is going to be a success, both financially and for the business. It's going to be successful going long term to keep our employees employed and that business continue. So a lot of opportunities there. We're running up against the clock now. Any other questions come in, Adam? I guess we must have been very clear in our explanation.
Yeah, no questions. I guess I'll throw out the softball here, Mike. What the question would be: how does somebody, if somebody wants to learn more about the issues we've talked about today, what's the best way for them to get a hold of us?
Well, we're going to continue to report and follow on the latest developments. And so certainly as this, the pandemic continues, there's a lot of resources for clients and advisors on our website, McDonaldHopkins.com. If you think of questions that you want us to follow up with you on, you can continue to send those to events@McDonaldHopkins.com, or you can contact any one of us, and our emails are there on the screen now. If you have questions, if you want to get started in this process, we've got a great team at McDonald Hopkins that can help you successfully transition your business, exit your business, and work with your other advisors to make sure a plan is put in place that's going to be right for you.